Welcome to a new topic on corporate restructuring. In this introductory lesson, we learn the different types of restructuring and the motivations for corporate restructuring. Let's get started. Companies tend to go through four major stages in their life cycle. The startup stage, where the company starts receiving revenue, but free cash flow is negative as the company spends on capital investment and to attract customers. The growth stage is characterized by rapid growth in revenue, and the company may turn profitable. Revenue growth slows in the mature stage, and free cash flow peaks. In the decline stage, revenue growth is negative, and free cash flow starts to decline as well. In practice, the management of large, mature companies seek to continue to grow the profitability of the company through certain corporate actions. They can be broadly classified into three categories: investment, divestment, and restructuring. Investments seek to increase the size of the company, usually through the acquisition of another company. Managers may be motivated due to perceived synergies that the target company can bring, or the perception that the target is undervalued. Managers may also be motivated to hit certain growth targets, or to acquire capabilities or resources that the target company can bring. Divestments seek to reduce the size of the company through the sale of a business segment. Managers may divest to focus operations and business lines, or are forced to divest due to regulatory requirements. The reason could also simply be a need for cash, or that there are interested buyers willing to pay a high price. Restructuring are actions that seek to improve productivity to increase profitability. Managers may do this voluntarily to improve the returns on capital. Some restructurings are forced upon by the court, usually in the case of default on debt. On a macro level, there are two key drivers of all three types of corporate actions in the market. Firstly, high security prices in the economy. In general, it's observed that when stock and bond prices are high in a booming economy, the number of corporate activities in the economy increases. This may be due to rising CEO confidence. It is likely that CEOs take actions only when they are confident about the future. Another reason could be lower cost of financing. When bond prices are high, interests are low. And when stock prices are high, the market equity risk premium is low. Both debt and equity financed acquisitions will be made at lower costs. Also, the management knows that their stock is overvalued and would therefore take the opportunity to make equity-financed acquisitions. Divestments will also bring in more cash when its stocks are overvalued. Despite such trends, empirical studies suggest that corporate actions taken during weaker economic times tend to create more value. A study by BCG found that such weak economy deals have a 10% higher increase in shareholder return over 3 years than strong economy deals. Another macro reason is termed industry shock, which is a phenomenon where managers are influenced to follow what others in the industry are doing. This can encourage corporate actions in certain industries. Note that the CFA Institute labels all three of these categories of corporate actions as corporate restructuring, and hence this entire topic is named as such. You should be aware that when we say corporate restructuring, we are referring to all three of these categories of corporate actions. And now let's learn some of the specific types of action within each category. Investment actions can be equity investments, acquisitions, or joint ventures. An investment company is said to make an equity investment in an investee company when it purchases a material stake, but is less than 50% of the investee's shares. The two companies maintain their independence, but the investor company may have representation on the investee's board of directors to influence operations. Equity investments are often made to establish some form of strategic partnership. In some cases, it may simply be that the investor company believes the investee is undervalued. It may also be an initial step towards an eventual acquisition. An investment is considered an acquisition when the investor buys most or all of the investee's shares to gain control. In an acquisition, the investor is known as the acquirer, and the investee is the target. Once an acquisition is complete, the target becomes a subsidiary of the acquirer, and the acquirer will report a single set of financial statements that include the results of the target. We've learnt the accounting aspect in the FSA course. In a joint venture, two or more companies contribute resources, knowledge, and capital to form and jointly control a new, separate company to achieve a business objective. The participants will share in the joint venture's profits or losses. A common use of joint ventures is conducting business in new markets. A company with a product or service will form a joint venture with another company with local business knowledge and connections. A divestment is the act of removing a particular segment of a company. A sale, also known as a divestiture, is the other side of an acquisition. That is, the segment is the target of an acquisition. The acquirer pays the seller cash for the business segment, and it gets transferred to the acquirer. The seller is no longer exposed to the divested business, and the cash may be returned to its shareholders or put to better use in the company. The other type of divestment is a spin-off, where there is no sale to another party. The company separates the particular business segment into a new independent company called the spin-off. The new company creates new shares, which are distributed to the subject company's shareholders in proportion. The shareholders can choose to sell the shares or keep them in their portfolio. The two companies are independent from each other after the spin-off. The goal of a spin-off is usually to increase management focus on its core business by getting rid of unrelated business segments. Restructuring often comes in the form of cost restructuring, balance sheet restructuring, or reorganization. Cost restructuring actions typically follow periods of underperformance. Managers aim to improve the operational efficiency of the company by lowering costs. One approach is to outsource standardized business processes to third-party vendors that have lower costs due to their economies of scale. Common outsourced processes include IT, call centers, HR, and manufacturing. However, companies generally have to approach outsourcing with caution, as there may be quality issues, incompatible work culture, or disruptions in services. Another form of cost restructuring is offshoring, that is to relocate certain business processes to another country with lower costs. Unlike outsourcing, the business process is still kept in-house, just that it resides in a lower-cost country. Many manufacturing companies from developed countries set up factories in emerging countries to take advantage of lower input costs. In practice, companies often practice both outsourcing and offshoring according to what makes sense for the company. Usually, the more generic processes are outsourced. Balance sheet restructuring involves changing the mix of assets and/or changing the capital structure. In a sale and leaseback, the company sells an asset to a lessor for cash, and then leases the asset back for its operations. This results in an immediate cash infusion for the company. Accounting-wise, this is equivalent to the lessee taking a fixed-rate loan from the lessor at rate implied in the lease. This arrangement only makes sense if the lessor is able to obtain financing at a lower rate than the lessee. Dividend recapitalization involves taking on more debt and using the cash to pay out dividends to shareholders. The objective is to lower the firm's WACC by replacing equity in the capital structure with debt, which has a lower cost than equity. However, higher leverage comes with higher risk, so this is to be used sparingly, limited to companies with very stable cash flows. Reorganization is a court-supervised process for companies facing insolvency. The court oversees the negotiation between the insolvent company and its creditors for asset sales, conversion of debt to equity, and refinancing. If there is an agreement, the court can approve the new terms that the creditors have accepted. All through this process, the company remains operational. If reorganization fails, the company goes into the liquidation process, where the court will decide on the divestment of assets and the distribution of proceeds to creditors. And lastly, a leveraged buyout is a special kind of corporate restructuring that involves investment, divestment, and restructuring. In an LBO, a private equity firm first purchases a target company using a large amount of debt to finance the investment. Subsequently, unrelated parts from the acquired company are sold to generate cash to service the significant debt. Restructuring of the remaining business operations is performed to improve efficiency and profitability and grow the business. Eventually, there is an exit via a sale or IPO where the PE firm hopefully makes a profit. Leverage buyouts are covered in detail in the Alternative Investments course. And that concludes this introductory lesson on the types of corporate restructuring and the motivations to restructure. In the following lessons, we'll learn how to evaluate corporate restructuring actions. See you again.